Welcome to our Money Basics series. Today, we're exploring one of the most fundamental concepts in finance: interest. Whether you're saving money in a bank account, taking out a loan, or making any financial decision, understanding interest is absolutely crucial. Interest affects nearly every aspect of our financial lives, from the money we earn on our savings to the extra amount we pay when borrowing money. By the end of this video, you'll have a clear understanding of what interest is, how it works, and where you'll encounter it in your everyday life. So what exactly is interest? Interest is simply the cost of borrowing money or the reward for lending money. Think of it this way: when you lend money to someone, you expect something extra in return for not having access to your money during that time. That extra amount is called interest. On the flip side, when you borrow money from a bank or financial institution, you pay them extra money for the privilege of using their funds. This extra payment is also interest. Interest is essentially the price of money. It compensates lenders for the risk and opportunity cost of lending their money. There are two main types of interest you need to know about. First is simple interest, which is calculated only on the original amount of money you borrowed or deposited. This original amount is called the principal. Simple interest remains constant throughout the entire period. The second type is compound interest, which is calculated not just on the principal amount, but also on any interest that has already been earned or charged. This means the interest grows over time because you're earning interest on your interest. Today, our focus is on simple interest, which is easier to understand and forms the foundation for learning about compound interest later. The formula for calculating simple interest is straightforward and easy to remember. SI equals P times R times T divided by 100. Let me break this down for you. SI stands for simple interest. That's the amount of interest you'll earn or pay. P represents the principal amount, the original sum of money. R is the rate of interest, expressed as a percentage per year. And T stands for time, the duration for which the money is borrowed or invested, measured in years. This formula is your key to calculating simple interest in any situation. Let's work through a practical example to see how simple interest works. Imagine you deposit 10,000 rupees in a bank account that offers 5% simple interest per year. You plan to keep the money there for 3 years. Using our formula, the principal P is 10,000 rupees, the rate R is 5% per annum, and the time T is 3 years. When we substitute these values into our formula, we get the simple interest as 1,500 rupees. This means after 3 years, you would have earned 1,500 rupees in interest on top of your original 10,000 rupees. Let's walk through the calculation step by step to make sure you understand the process completely. Starting with our formula, SI equals P times R times T divided by 100. We substitute our values. SI equals 10,000 times 5 times 3 divided by 100. First, we multiply 10,000 by 5 by 3, which gives us 150,000. Then we divide this result by 100. 150,000 divided by 100 equals 1,500. So the simple interest earned is 1,500 rupees. Remember, this is just the interest. Your total amount would be the principal plus the interest, which is 11,500 rupees. Simple interest is commonly used in various real-life financial situations. Bank deposits like savings accounts and fixed deposits often use simple interest calculations, especially for shorter terms. Many personal loans, particularly short-term ones, calculate interest using the simple interest method. Car loans sometimes use simple interest, especially for certain types of auto financing. Student loans may also apply simple interest rates, depending on the lender and loan terms. Understanding these applications helps you make better financial decisions, whether you're earning interest on your savings or paying interest on borrowed money. Let's recap the essential points about simple interest. Remember that simple interest is calculated only on the principal amount. It doesn't compound or grow over time like compound interest does. The formula SI equals P times R times T divided by 100 is your tool for any simple interest calculation. Simple interest is commonly found in savings accounts, fixed deposits, and various types of short-term loans. Understanding simple interest is fundamental to making informed financial decisions, whether you're choosing where to save your money or comparing loan options. With this knowledge, you're better equipped to navigate the world of personal finance and make choices that benefit your financial future.
If you like this video, hit that like button and don't forget to subscribe. Visit CodeLucky.com for more such useful content.